To further protect your wealth against inflation, it's important to understand how each investment strategy works in greater detail. By doing so, you can make more informed decisions that align with your financial goals and better safeguard your purchasing power. One effective strategy is investing in real assets, which tend to appreciate over time, often outpacing inflation. Real estate is a prime example. As inflation drives up the cost of living, property values typically increase as well. This not only boosts the value of your investment but also allows you to generate income through rental properties. Rental rates usually rise in tandem with inflation, providing a steady cash flow that keeps up with the cost of goods and services. Additionally, real estate investments offer a degree of stability, as property values are less volatile compared to other asset classes, making them a reliable long-term hedge against inflation. Another aspect of real assets includes commodities and precious metals. These physical assets have intrinsic value and are often sought after during inflationary periods. For instance, gold has long been considered a safe haven during times of economic uncertainty, maintaining its value when fiat currencies lose purchasing power. By allocating a portion of your portfolio to commodities and precious metals, you add a layer of protection that can counterbalance the inflationary pressures on other parts of your investment mix. Stocks, particularly those in growth sectors, offer another powerful tool to combat inflation. Over the long term, stocks have historically delivered returns that surpass inflation, helping to preserve and grow your wealth. Companies with strong pricing power, meaning they can pass increased costs on to consumers without losing market share, are especially valuable during inflationary times. As these companies raise prices, their revenues and profits can grow, driving up their stock prices. Additionally, dividend-paying stocks provide a dual benefit. Not only do they offer potential capital appreciation, but they also deliver regular income that can increase over time, helping to maintain your purchasing power. Bonds traditionally struggle during inflationary periods because fixed interest payments lose value as prices rise. However, certain types of bonds are designed specifically to address this issue. Treasury inflation-protected securities, TIPS, are a prime example. The principal value of TIPS adjusts with inflation, ensuring that your investment's real value doesn't erode over time. As inflation rises, the payout on these securities increases, providing a reliable source of income that keeps pace with rising prices. Similarly, inflation-linked bonds from other issuers can offer protection by tying returns directly to inflation metrics. A diversified portfolio is another key to inflation protection. By spreading your investments across various asset classes, you reduce the risk that any single investment will underperform due to inflation. For instance, while bonds may struggle in a high inflation environment, real estate and stocks might perform well, balancing out your overall returns. Moreover, including international investments in your portfolio can expose you to different economic conditions and inflation rates, providing additional layers of protection. Adapting your investment strategy to changing inflationary environments is crucial. Inflation isn't a static phenomenon, it fluctuates based on numerous factors, including economic policies, global events, and market dynamics. As such, regularly reviewing and rebalancing your portfolio ensures that your investments remain aligned with the current economic climate. During periods of rising inflation, certain sectors, such as energy, utilities, and consumer staples, often perform better. These sectors provide essential goods and services that consumers need regardless of price increases, making them more resilient during inflationary periods. By shifting your investments toward these sectors, you can better protect your portfolio from inflation's adverse effects. Another vital component of inflation protection is understanding the relationship between interest rates and inflation. Central banks often raise interest rates to control inflation, which can impact various investment classes. Higher interest rates typically lead to lower bond prices, but they also increase the yields on newly issued bonds, offering better returns for investors. Floating rate bonds, which have interest payments that adjust with inflation, can provide an attractive income stream that rises along with prices, helping to maintain your purchasing power. Investing is a proactive approach to preserving your future purchasing power. As inflation erodes the value of money, investments that grow faster than inflation become essential for maintaining your lifestyle. By focusing on assets that historically outpace inflation, you ensure that your wealth continues to grow in real terms, securing your financial future. In summary, protecting your wealth from inflation involves a combination of strategies tailored to your individual financial situation. Real assets like real estate and commodities provide intrinsic value that often appreciates with inflation. Stocks, particularly those with strong pricing power and dividend potential, offer long-term growth that can outpace rising prices. Inflation-protected bonds provide a reliable income stream that adjusts with inflation, while a diversified portfolio helps balance risks across various asset classes. Regularly adapting your investment strategy to current economic conditions, including interest rate trends, ensures that your portfolio remains resilient in the face of inflation. By taking these steps, you can effectively shield your finances from inflation's impact, preserving your purchasing power and securing your wealth for the future. Another critical aspect to consider when safeguarding your wealth from inflation is the role of alternative investments. These are assets outside the traditional categories of stocks, bonds, and cash. Alternative investments, such as private equity, hedge funds, and venture capital, offer unique opportunities to generate returns that are less correlated with the broader market, providing an additional layer of protection against inflation. Private equity involves investing directly in private companies, which often have the potential for substantial growth. These companies can be more agile and innovative, allowing them to adapt quickly to inflationary pressures by adjusting pricing strategies or expanding into new markets. As these companies grow, they can deliver significant returns that outpace inflation, making private equity a valuable component of a diversified investment strategy. Hedge funds, known for their flexible investment strategies, can also play a crucial role in inflation protection. These funds employ various techniques, such as short selling, leveraging, and derivatives, to generate returns in different market conditions. During periods of inflation, hedge funds can position themselves to benefit from rising prices and interest rates, providing a hedge against the negative effects of inflation on more traditional investments. Venture capital, which focuses on early-stage companies with high growth potential, is another alternative investment avenue. These companies are often at the forefront of innovation, developing new products and services that meet emerging consumer demands. As inflation drives up costs, companies that can innovate and adapt are more likely to thrive, offering investors the potential for outsized returns that can significantly outpace inflation. Real assets like infrastructure and natural resources are also vital components of an inflation-resistant portfolio. Infrastructure investments, such as toll roads, utilities, and airports, typically generate stable, inflation-linked revenues. These assets are essential to the functioning of economies, and their ability to pass on rising costs to consumers ensures that their cash flows remain robust even during inflationary periods. Natural resources, including oil, gas, and minerals, often see price increases during inflationary times, making them a strong hedge against rising prices. Cryptocurrencies have also emerged as a potential inflation hedge, particularly as concerns about the long-term value of fiat currencies grow. While the volatility of cryptocurrencies like Bitcoin can be a risk, their decentralized nature and limited supply have led some investors to view them as digital gold. In an inflationary environment, where traditional currencies may lose value, cryptocurrencies could offer an alternative store of value that preserves purchasing power. Incorporating these alternative investments into your portfolio requires careful consideration of your risk tolerance, investment goals, and time horizon. While alternative assets can offer substantial returns, they also come with higher risks and lower liquidity compared to traditional investments. Therefore, it's important to balance these factors when determining the appropriate allocation of alternative investments in your portfolio. Another strategy to enhance your inflation protection is to focus on investments in innovation and technology. Companies at the cutting edge of technological advancements are often better positioned to navigate inflationary environments. These companies can introduce new efficiencies, reduce costs, and offer products that consumers value highly, even in times of rising prices. As a result, investments in technology sectors can provide both growth and a buffer against inflation. Global diversification is another crucial strategy. By spreading your investments across different geographic regions, you reduce the risk associated with inflation in any single country. Emerging markets, in particular, can offer attractive opportunities during inflationary periods. These markets often experience higher growth rates, and their economies may be less correlated with those of developed countries, providing a unique hedge against inflation. Regularly reviewing and adjusting your portfolio is essential to maintaining its inflation resilience. As economic conditions change, so too should your investment strategy. By staying informed about inflation trends and being proactive in adjusting your investments, you can ensure that your portfolio remains well positioned to weather inflationary pressures. This ongoing process of review and adjustment is critical to protecting your wealth and achieving your long-term financial goals. Inflation protection is not a one-size-fits-all approach. It requires a tailored strategy that considers your unique financial situation, goals, and risk tolerance. By diversifying your investments across traditional and alternative assets, focusing on sectors that thrive during inflation, and staying adaptable, you can build a robust portfolio that not only withstands inflation but also grows in value over time. This proactive approach to managing inflation risk ensures that your wealth remains secure, allowing you to meet your financial objectives and enjoy the lifestyle you desire. While diversifying and adjusting your investment portfolio are crucial strategies for managing inflation, another key aspect is understanding the broader economic context in which inflation occurs. Inflation doesn't happen in isolation, it's often influenced by a combination of factors such as monetary policy, fiscal stimulus, supply chain disruptions, and global economic trends. Being aware of these underlying drivers can help you make more informed decisions about how to protect your investments. One of the most significant drivers of inflation is monetary policy, particularly the actions of central banks like the Federal Reserve in the United States. When central banks lower interest rates, they make borrowing cheaper, which can stimulate economic activity. However, if interest rates remain low for too long, or if central banks engage in excessive money printing, this can lead to an oversupply of money in the economy, which in turn can drive up prices. Conversely, when central banks raise interest rates to combat inflation, this can have a cooling effect on the economy. Higher interest rates make borrowing more expensive, which can slow down consumer spending and business investment. While this can help to curb inflation, it can also lead to slower economic growth and potentially trigger a recession. Understanding the relationship between interest rates and inflation is essential for making informed investment decisions. Another factor to consider is fiscal policy, which refers to government spending and taxation. During times of economic crisis, governments often increase spending to stimulate growth, as seen during the COVID-19 pandemic with massive stimulus packages. While this can provide a short-term boost to the economy, it can also contribute to inflation if it leads to an increase in demand that outpaces supply. Investors need to be mindful of how government policies can impact inflation and adjust their strategies accordingly. Supply chain disruptions are another critical factor that can drive inflation. The COVID-19 pandemic highlighted the vulnerability of global supply chains as lockdowns and restrictions led to shortages of goods and raw materials. When supply is constrained and demand remains strong, prices naturally rise. This is particularly evident in sectors like technology, where shortages of semiconductors have led to higher prices for everything from smartphones to cars. Investors should pay close attention to supply chain trends and consider how they might impact inflation and investment opportunities. Global economic trends also play a role in inflation. For instance, emerging markets often experience higher inflation rates than developed economies due to factors such as faster economic growth, less mature financial systems, and greater exposure to commodity price fluctuations. Investors who diversify their portfolios globally should be aware of the inflation risks in different regions and adjust their strategies to account for these differences. In addition to these macroeconomic factors, it's also important to consider the role of expectations in driving inflation. When consumers and businesses expect prices to rise, they may act in ways that contribute to inflation. For example, businesses might raise prices in anticipation of higher costs, while consumers might accelerate their purchases to avoid paying more in the future. This self-fulfilling prophecy can lead to a cycle of rising prices that becomes difficult to break. Understanding how expectations shape inflation can help investors anticipate market movements and adjust their strategies accordingly. Inflation can also vary significantly across different sectors of the economy. For example, while inflation might be low in the technology sector due to rapid innovation and falling costs, it might be higher in sectors like healthcare or education, where prices have historically risen faster than the overall inflation rate. Investors should consider sector-specific inflation trends when building their portfolios, as these can have a significant impact on the performance of different asset classes. To effectively manage inflation risk, it's also important to stay informed about the latest economic data and trends. This includes keeping an eye on inflation indicators such as the Consumer Price Index, CPI, Producer Price Index, PPI, and inflation expectations as measured by surveys or bond market data. By staying informed, investors can make more timely and informed decisions about adjusting their portfolios to protect against inflation. Ultimately, protecting your wealth from inflation requires a multifaceted approach that takes into account both the broader economic context and the specific characteristics of your investments. By staying informed, diversifying your portfolio, and being proactive in managing risk, you can build a resilient investment strategy that not only preserves your wealth but also positions you for growth in the face of inflation. This comprehensive approach ensures that your financial future remains secure, regardless of the economic challenges that may arise. Don't forget to subscribe in the channel and like the video.